Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management, and we certainly want to welcome all of our viewers from across the U.S., and we certainly hope that you've had a fantastic week so far. But before we waste more time, we want to get right into that weekly update that I know that everyone here is looking to get started on. And so, as we go into 2021, a lot of the same distractions that we experienced in 2020 remain intact, right? So we know that there's a lot of political noise out there, economic noise, and even, the ongoing threat as it relates to the pandemic. And one thing we want to remind ourselves on a daily basis is that we have to keep things simple, right? At the end of the day, all of those factors remain distractions as it relates to a solid long-term investment strategy. Right now, in an environment that's dominated by an economic recovery where money is cheap and inflation is low, let's not overthink things, right? When we see an environment such as this, that tends to be very positive for asset prices. And when we look at the current rally, there's a lot of talk about 2000. It really doesn't look like 2000. It looks more like the recovery of 2009. And we want to remember that because, yes, are there pockets of froth such as in the EV sector or in the solar sector? Absolutely. But the market as a whole, the individual companies that we focus on, right now it reminds us more of 2009 and the early stages of that economic recovery following a traumatic event, which in 2008, 2009 was that global financial crisis. This time around was the COVID-19 crisis. So again, the path to least resistance at this point does remain higher according to our research. Backing that up is credit, right? When we look at the credit markets, they look strong. We see credit spreads, that implied credit risk, continuing to fall, and that provides a strong foundation for overall asset prices. And again, we have to remember that stocks are politically agnostic. They're not Republican, they're not Democrat, they're not centrist, libertarian, or green. They are agnostic, and they look at companies on an individual basis, and they assess the economy as it relates to potential returns on invested capital. We have to remember that. That's the most important thing that we can remember that will increase our likelihood of success. Last week, we talked about our 2020 performance up 101.05% here. We can see that in this category. So far here in 2021, off to a solid start. We're up 3.01% versus 1% for the S&P 500. So again, a lot of those established dominant themes from 2020 have continued, and we're seeing a high degree of persistence factors as it relates to performance here so far, very, very early in 2021. We're certainly happy with the performance there. Here, I love this chart. When it looks at the overall performance of the S&P 500 as it relates to Democratic presidents, Republican presidents, and the ensuing congressional makeup. What do we see here? A statistically insignificant change between whether we have a Republican or Democratic president or a Republican or Democratic Congress. And there's a reason for that, is that because stocks at the end of the day don't care who's in power. Secular change and innovation are far more powerful than the knuckleheads in DC that create a lot of noise and bluster and often screw things up more than help. And so at the end of the day, we want to invest in businesses, not in headlines, not in the media. We invest in individual businesses and the themes that are dominating those businesses. This is what we were talking about, not overthinking the investment environment right now. Yes, there are those noisy factors of elections, international politics, geopolitics as it relates to China and Europe and trade. But at the end of the day, what matters? Liquidity matters. Interest rates matter. Fundamentals matter. And what we see here is the annual growth in U.S. money supply continues to skyrocket, right? Interest rates remain near cycle lows. China's doing the same thing. Look at the liquidity increases in China. So you got the two behemoths of the global economy all doing the same thing, pumping money into the system, keeping interest rates low, and goosing asset prices. Go and invest based on the path of least resistance. Don't be a hero. It's not going to lead to returns. And that, at the end of the day, is what matters when it comes to investing. This is not 2000 is the point of this slide here. Is so when we look at the overall structure of the current stock market versus 2000, what do we see? Most sectors, most individual stocks are in a strong trend backed by strong short-term momentum. What we saw in 2000 was an exhaustive peak where stocks had already started to enter into a negative trend. So structurally and technically and quantitatively, we saw those stocks start to deteriorate while just a few stocks were holding the overall market up, and short-term momentum was rapidly deteriorating and decreasing. You can see here a picture says 1,000 words, right? Up and to the right is what 2021 looks like. Down and to the left is what 2000 looks like, right? So again, we couldn't, when we compare the two bull markets, one was an exhaustive peak back in 2000, 2021 looks more like the early stages of a bull market. Very, very important difference as it relates to those two bull markets. We get a lot of questions around the incoming Biden administration. What does it mean for investing? What does it mean for stock selection? Be very careful about investing based on politics. The same way we don't want to, go to cash or invest in the market based on political rhetoric, we don't want to apply political rhetoric to stock selection, right? When we look at the Trump administration, they were very pro oil and gas and coal. What were some of the worst performing sectors under the Trump administration? Oil and gas and coal. So far, since Biden has won the presidency, what has been one of the best performing sectors? Oil and gas, right? Solar has also done well. But what we want to caution investors on is that right now invest in solar stocks and clean energy stocks are going parabolic. When we look at the performance of traditional energy versus solar, it's two standard deviation lows. So, and again, we would actually probably, if you put a gun to our head, we would be buying oil-based energy versus solar-based energy at this point. Right now, we're not playing either space because the long-term picture for energy still doesn't look that great. But again, the parabolic moves as it relates to solar and clean energy, we would be careful at this point. And thankfully for our portfolios, we have a 0% weight in all of these sectors right now. We would say the same for gold and Bitcoin, right? Gold and Bitcoin, two safe havens right now. One thing that we've started to notice is the US dollar is starting to bottom, right? What happens when the US dollar bottoms? We see those safe havens start to sell off. At the end of the day, gold and Bitcoin are a hedge against the US dollar. It's a form of currency, right? So when we think of gold and Bitcoin, they're not really safe or safety instruments. They're more of a hedge against the US dollar. So the fact that we see the US dollar finding some short-term support here, it's very oversold. We could see the US dollar rise and then gold and Bitcoin reset lower. So be very careful there here in the short term with those two asset classes. As we mentioned at the beginning of our presentation, credit remains healthy. Right? We look at the performance here year to date of leveraged loans and high yield bonds relative to treasuries, right? You would have lost money owning safe treasuries and made money buying leveraged loans and high yield bonds. Again, past performance, not indicative of future results, but we do continue to see that continued improvement in the overall credit market. So we can see here high yield spreads, implied credit risk in that high yield market, junk market, continuing to improve and fall. That's a good thing. You want to see that. As those fall, that means lower mortgage rates for your family. That means lower interest rates for just traditional loans at the bank, commercial loans, corporate loans. All of this stuff is good because it allows companies and investors and people to deploy capital more efficiently and ultimately generate higher returns on invested capital. One thing we want to point out real quick here, we get a lot of talk about the index. Should I invest in the index? Yada, yada, yada. No, please avoid the index, avoid index products. Yes, they're cheap, but there's a lot of risk in there, right? So when we look at the overall concentration in each respective sector within the S&P 500, look at how much concentration there is. If you look at the communications sector, the top 3 stocks make up 60% of the 60% of the sector. Consumer discretionary, 55%, and that's made up of Home Depot, Tesla, and Amazon. Energy, 52%. Technology, 46.5%. Across the board, we see a high degree of concentration within the index. In fact, the top 5 stocks in the S&P 500 make up 25% of the index. In other words, $25,000 of every $100,000 you invest, $25,000 is going into 5 stocks. The other thing is it's inefficient. Tesla recently got added to the S&P 500 after going up 700%. I would have preferred it been added 1/7 of the price, not at 700%. So again, yes, we get a lot of talk about index investing and everything else. But when we look at the concentration mix, when we look at the inefficiencies as it relates to adding new companies after they've already increased massively in value, and we consider the fact that 15% of companies out there are considered zombie companies, in other words, their cost of debt is greater than their earnings, in other words, deteriorating equity value over time, we actually think the index is kind of a risky investment. So something to be aware of, and it's why an active approach to investing can really help you and your family over the long term generate returns that are needed to ultimately have an enjoyable retirement. So overall, we have ample liquidity, strong breadth in the market, right? More and more stocks are participating in the rally, and that tends to be supportive for stocks. And we think that will be supportive here in 2021. So overall, that rising supply of cheap money backed by strong credit markets. And again, last point here, please don't get distracted by politics or the media. Thank you so much for all of your support and your trust. If you have any questions, please reach out to your advisor or to our team here at LifePro. Thank you again and have a great weekend. Thanks again.